Okay, welcome back, everyone, to another episode of Real Talk, where we talk about the myriad ways that you can make money in real estate. So I got guests today, Param. I met him very recently, and has a really cool story. And he started with single family, and then delved into multifamily, which is a not an uncommon story, but his path, of course, has its own nuances and uniquenesses. So I'm happy to have him here. And Parham, welcome to the show, man.
Thank you, man. Yeah, I just really appreciate um, being on the show. I appreciate you taking the time to talk with me, and I'm excited to share my story with you guys.
Awesome, man. Yeah. So let's dive in. So tell me, how did so I do remember when we first talked that your first investments were short term rentals, right?
Yeah, so so I'll give you a little bit of background. My wife and I both are we work in management consulting. So we work in IT. I've worked in IT consulting for the last 24 plus years, and so we had a good disposable income, and so we did what everybody tells us to do is, hey, you got to be investing. So we did we've been doing our 401k, we're doing our retirement, and then we got into sort of real estate investing just by chance. Like we took a vacation to Disney, and we saw some short-term rentals. This is back before, I'm dating myself, but this is back before Airbnb was even a thing, right? So Orlando had like this hotspot of like short-term rentals. And I was like, this is a great model. Let's buy something. Let's build something. So we actually ended up building a a single family, a villa, right, with a pool and the whole works, all amenities, and we put it out to short-term rentals. And a lot of it, our discussion was, we'll do it for short-term rental, but it'll be a nice place for us to vacation. We used to live in New Jersey, Pennsylvania at the time, so when it got cold, we're like, all right, let's go down to Florida. So it would really be a place for our family, but then we're like, all right, let's do this short-term rental thing. So that's how we got started. We knew, we should be investing in real estate. And so those are our first sort of investments into the short term rental market or single family homes, and leasing them out like that. And this is, again, way before Airbnb was even a thing. And so, that's what we ended up doing. The issue that I found during that was, you know, we didn't know what we were doing. I wasn't managing it. There wasn't a whole lot of automation, so you had to rely on property management. So a lot of our profit went to paying property management at the time, right? Which, in the Disney area, and so it didn't really net too much, but everybody tells you like, oh, don't worry about cash flow. You're building equity. You're building equity. So we kind of went with that. But that was our initial kind of entry into real estate investing. Now, my brother Rav, he's done the same thing or similar things with his family. Like he had a couple single family home rentals here in Texas, and he's investing on his own. And so about 6 years ago, 6 or 7 years ago, we looked at our stuff and said, look, this is not really the cash cow that we thought it was going to be, right? Single family homes and the short term rental stuff, especially when we're paying property management. And so we're like, let's do something together. And so what should we looked at which asset class we should be in, or asset type we should be in, and we said, let's go all in on commercial multifamily. Did our research and said, let's do that. And so we literally sold all of our assets overnight, and then took the money and bought our first apartment complex. And that was just me and him, and we bought it in our backyard, 16 units here in San Antonio. And that was our entry into commercial real estate, commercial multifamily real estate. And so, that was kind of how we got into it. And I'm so glad we did. I mean, fast forward to today, we're now what, 3,500 doors, apartments, under our belt, after 3 plus 3.5 years of syndication. And so initially when we started, it wasn't syndication, it was our own money. And so when we did pretty well, that's when we got into syndication.
That's so six. I know you said did 3,500 in 3 years with syndication. So you went from 16 doors to 3,500 doors in 3 years, or
Yeah.
when you first started? Wow.
Yeah. Yeah. And so this was like, I had a couple of aha moments, and like, and you got to understand the personalities behind this, right? So me, I come from an IT and consulting background. So before I jump into anything, I have to have all this information. I got to be like, no, man, we need all this analysis stuff to really move forward with something. Even though my gut's telling me do it, right? I still need that analysis. My brother Rav, he's a very like, we'll figure it out attitude, right? Let's go do it. We'll make mistakes. It's all good, but we'll learn as we do it and we'll figure it out, right? So that's his personality. So we balance each other really well. And so when we started, we were doing it only with our money, obviously, right? And so we could, you hit this like ceiling of what you can do. So all we could buy was 16 units at the time, right? But you know, we learned what to do, how to do it. We learned the basic business model of value add, right? That, hey, all we have to do is, and they were fairly, all 16 units were rented. And so we raised rents a little bit. We improved things on the property. 2 years later, we sold it and we more than doubled our own equity in 2 years. It was ridiculous, right? Because just the whole model of value add. And then, so we didn't cash flow a single penny. This is, I want everybody to kind of understand, this investment model when you're doing it with your own money versus when you're doing it with somebody else's money. We didn't cash flow a single penny. So what that means is we spent every last dime buying this property. And then we said, okay, we didn't budget anything for like rehab or anything. We're like, oh, we'll be collecting rent. So as we collect rents, we'll fix things as we go and, rehab and do all that. That sounds great on paper. It doesn't work out, right? Because there's unforeseen things that happen. And so we learned along the way, but like we were doing it all of ourselves. So we're like, um, I was fixing toilets. It was fixing mailboxes. We were collecting rents. We were processing evictions, like all of that. And so very quickly we learned I don't like doing any of that. Right. And so we're like, all right, and so, but we sold it. So we didn't cash flow a single penny during the 2 years that we owned it, because everything that we came in with rent, we put it right back into the property. Which was fine because we were all working at the time. I still had a full-time job at the time. So I'm getting a paycheck. So I didn't need the property to pay me on a regular basis, no cash flow. But we knew that we were making that property better. So ultimate goal was to sell. So when we sold it, we more than doubled our equity. So that was an aha moment for me. Like, holy crap, like we barely did anything for the last 2 years. I mean, we did do stuff, but like, we raised rents very little, like 25, $50, but like that compounded the value of the property significantly where we doubled our equity. So I was like, dude, let's do it again. Let's 1031. Let's go buy something else. But then we knew we didn't want to do property management. We didn't want to fix things. So I'm like, all right, we bought a 52 unit property. So we went from 16 to 52 unit property. But this time we're like, all right, we got to hire property manager. We got to hire full-time maintenance. And then we're hands off. Right. And so we learn every step of the way. And so we didn't do everything right on that property either. Again, we barely cash flowed that property too. But again, it was our money. It was just me and Rav. We weren't beholden to investors. We weren't distributing anything. We weren't taking anything. And so we're like, all right, anything that we're making, we're putting back into the property. We're hiring, we're fixing the fence, we're putting in a playground, we're doing all these things just out of rental income. And so same thing, we more than, I think it was like about 22 months, and we sold it. We more than doubled our equity again. And so that's when people came out of the woodworks. Our friends and family are like, dude, you guys are killing it. We're seeing how successful you guys are. How do we participate? How can we invest? And so they were giving us money, and we're like, I don't want your money right now. Like, I don't know how to do that properly. So let me educate myself. And so that's when we were like, all right, we got to do this the right way. And so we found people that are smarter than us, that are doing syndications, that are doing big properties. And we learned about syndications. And that's when we were like, all right, this is how we need to do it. If we're taking investor money, this is exactly how we do it. But again, we didn't have the experience of like, big syndications. We had 52 units. That's it. And so to do a syndication, we're like, the best thing to do is let's find somebody that's done this really, really well, expert operators, expert property managers, excellent asset managers, and partner with them. And so somebody gave us a chance and said, we said, hey, we have equity, right? We have investors in our friends and family network that want to invest in something big and safe. How do we do it? And so we found an opportunity where we could co-GP. We signed on the loan for this $30 million property. So we went from 52 units to like 212 units, $30 million property in the heart of Dallas, with a partner of ours, and so they give us our first chance, thankfully, and that was our first syndication in December of 2019. We could have never taken down a $30 million property, right? But the fact that we partnered with people that had that expertise, and we brought our own expertise to the table, together we were able to do that. And so it was a huge milestone for us. And now we have an opportunity and an avenue for our investors to invest the same way that we've been doing in these value add commercial multifamily, but much bigger way, because then we could take advantage of economies of scale and lower the risk from that perspective. And so again, yeah, that was our December 2019 was our first syndication. And so before that we had 50 units, and today we're 3,400 plus across Dallas, Houston, Phoenix, North Carolina, South Carolina. So that's been our story, and so we've done 15 plus deals across all of those different geographies through these partnerships.
Man, that's incredible. It's really incredible how like you really contrast well the idea of forced appreciation that you can't. I feel like it might be coming, but it's not really here yet. You can't really force appreciation in single family unless you renovate, right? And
Yep.
even then, you're
Even then,
still even then it's the sales comparison approach, right?
yeah, it's
That standard appraisal.
price per square foot, right? In the neighborhood that you're in. So
Exactly.
regardless of income, and that was a big aha moment for me when we were looking at, do we keep our STRs or do we go into commercial multifamily? And literally we sold all of our assets overnight, because I was like, that was the aha moment. Like, I cannot force, or I can't predict or influence the value of my single family, regardless of the income that it's generating.
Yeah.
I can't do it, because when I want to sell that one asset off, it's just price per square foot, it has nothing to do with income. And when I saw like this price comparison of like, you have two apartment complexes, commercial, side by side, they're identical. They were built the same time. They're identical. They have the same number of units. One could be worth $1 million more than the other one because of the income that it's generating. And so that was a big aha moment for me, is like, wow, like I could actually predict what my apartment complex is going to be worth just based on where I think my income is going to go. Right. And so the predictive modeling and that like financial engineering of commercial income generating assets is huge. And that's one of the reasons that, we're in multifamily, commercial, we're in self-storage, we're looking at industrial, because they're all commercial income generating properties that we can, again, have a very predictive model to say, if I bring my rents here and my expenses down, this property is going to be worth, the bank's going to tell me the property's worth X more million, in 3 years time or whatever. And we have some semblance of influence and control over that versus single family, which it just doesn't exist.
Yeah, I hear you, man. I hear you. Um, I feel like I do feel like there might be some indirect. Um, just I had a property that I bought and sold a year later at a 40% appreciation when the overall market didn't really do that, and I did sell it to. I operated as a short term rental. I still manage it. In fact, I sold it to investors, and at the same, it did have to
Yeah.
appraise it. Now it did have to appraise, and it did. Sometimes I don't really understand why appraisers say what they say. I was like,
It's
did
arbitrary in some cases, right?
it
Yeah.
is, man. It's like, did people coming in and doing short-term rentals in this market drive up prices? So was there like an indirect forced appreciation, or did I actually force appreciation and the appraiser just found a way to agree with the
Yeah.
sales price? Like it's definitely convoluted at best. It's not
Yeah.
clear like, hey, rents went up 50%, so the value went up accordingly, right?
Yeah.
It's definitely not like that. I am curious, man, like so when you at some point you can't really add more value to a complex. Who comes in and buys it then, right? So we're talking about you made it to A class, right? Like
Mhm.
it's no renovations needed for the next decade or two.
Yep.
Is it like my because I'm like entrenched in short term rentals right now, so I barely like lift my head up to see what's going on in multifamily. So I'm
Sure.
curious, man. Like, what is it like insurance companies or these really big mutual funds, like these big institutions that just have really low risk thresholds that are like, cool, we'll take an A class apartment complex that barely cash flows.
So, let me, I'll answer that question, but I'm going to backtrack to the single family stuff because I know, for STRs, for people that are listening around single family homes and want to invest in a big way in STR, the only way, and not the only way, obviously the last 2 years of the single family home market, people that owned any sort of portfolio, whether it's one home or 20, saw this huge spike, right, in their value, which is tremendous, which is awesome.
Yeah.
Um, that's not normal, but it does happen, right? And so if you're in the single family market and you're income generating, you can ride that out to where there's a peak and potentially offload an asset at the top, which is tremendous, right? And a lot of people did that. I did that, with one of my properties. But the thing that I like about STR, and this is one of the things that we're looking at, is building a portfolio, right, of STRs or single family homes that are income generating, cash flowing, and then selling that as a portfolio to an investment company. People
Yes.
are looking
Yes.
for that. So
Yes.
and the added flexibility of the fact that if you are at the top of a peak market in single family, you can offload one asset, two assets, five assets, but at any time from an investment perspective, you can sell on a cap rate. And that's the beauty of STR if you have a portfolio.
If you have a portfolio, yeah.
Exactly. You can sell on a cap rate. And so it treats it as a commercial product if you sell it as a portfolio, and the bank will appraise it as that type of asset as well. So
Oh wow, banks doing that? That will okay. You know
yeah,
what?
actually,
I've kind of seen that floating around out there where it's like, yeah,
yeah,
multiple property. Yeah.
yeah.
Wow.
So you
Yeah.
you can get around that because things are very dynamic, and people can get really savvy with it, especially with a portfolio, because you
Yeah.
can. I know we're looking at REITs like that are purchasing portfolio like that, like SDR portfolios like that of like 80 homes or whatever, and even in different markets. And so that's really the end goal from an exit standpoint if you're building a portfolio. So I did want to mention that. I don't want to steer anybody away from single family or STR, especially if you're building something that's going to be much more institutional versus kind of ad hoc, if that makes sense.
No,
So
perfect
going back,
sense.
yeah. So going back to your question, so if you're A class property, who's buying that? Same thing, REITs. So if you have an A class product, which we've moved from, we were doing some C class when we just had enough money to do that. But when you go to syndication, really the difference is not all that much from a raise, because you're raising capital to do things. So why not go to B class products or B plus or A class products, right? Unless you have this like, home run deal, slam dunk deal, that's a C class property. So going to more newer assets that don't have too much of a heavy lift in terms of rehab to be able to raise that value. Your end goal could be, if you're only going 25% of the way or 50% of the way of your own business plan. For example, if you have 200 units and you're renovating 30 of them, right? To prove a business plan that you can actually charge $100, $150 more in rent for those units, then that you can sell to another syndicator, right? That's going to continue that business plan and continue raising rents up. But if you're at the top end of that, your end goal is going to be somebody who either single, or you could do a syndication around this too, but basically a buy and hold asset. And there's plenty of syndicators out there that market this concept of infinite returns with a class A asset where you buy it, you're essentially still cash flowing, and class A properties will cash flow because and so you're still cash flowing, you're still doing distributions. They might not be huge, but there's still regular distribution that you can do. And then ultimately every few years you refinance and cash out. So you get this big payout every few years because you could just buy and hold it and just refinance every few years. And so you get this like return. Plenty of people are doing that. So you can look at syndicators that are doing that strategy, not a value add strategy, but a buy and hold strategy of this law of infinite returns. Two are REITs. REITs love property that they don't have to do anything with, and it's just on autopilot, right? And so again, their risk threshold is lower, and so their return threshold is lower too. And so they'll buy a portfolio, and it'll add to their aggregate kind of returns that they're modest returns that they're giving to their investors. So REITs love Class A properties, and any single investor, like a family office or something like that, they love properties like that too, because it's a great place to park their money in a safe way. And again, they're getting this regular modest return at that level potentially, but then there's an opportunity to refinance and cash out every few years. And that cash out it's not a liquidity event because you're getting your capital back. So it's a non-taxable event. So there's plenty of advantages from that perspective. So those are the types of buyers that we look for in some of our Class A, or where we've executed the majority of the business plan. There's not much more to go. That's kind of the types of buyers that we look for.
Gotcha. No, that makes sense. That makes sense. Cool. I'm curious, man. So when taking a kind of like going back and forth between multi and single family, but you've done both, man. That's so cool.
Yeah. And I'm continuing to do both. We're, like I said, we've done primarily multifamily. We're doing self-storage, we're doing land development, but I am looking at STR again, kind of similar to what you guys are doing, is in investing in a project that is institutional or portfolio driven. Like, we're building this portfolio that we're going to acquire X number of assets over the next year or 2 years, and then ultimately, a few years down the line, sell the portfolio on a cap rate. So yeah. Oh, I lost your audio.
Oops, sorry. Yeah. No, that's exactly what we're doing. We're launching in about 2-3 weeks out now to do exactly that,
that's
man.
exciting stuff.
Pumped, dude.
Exciting stuff.
But man, you're kind of an OG, dude, because you were. So if you're saying before Airbnb, then that means pre 2007, right? Yep. Doing short term rentals.
I bought that STR. I think it was 2000. I want to say 2004, 2005. Okay. We kept it for a while, but but here's another thing: we rode out the 2008, 2009 bubble because it was we wouldn't sell it at that time, but so we were income generating. So anything that was income generating, rode that out without any kind of really hurdle or speed bump. So that was great that it was income generating.
Can you say that, man? That is such a valid point, man. With these, when you're doing, it's like a natural guard and there's no like 100% guarantee, right? But it's
Sure.
like this really natural resistance to recession. Like, who cares what the price of real estate is if it's sending you a check every month,
Yeah.
right? One day it'll be worth more than it is today.
Yep.
Um, so you were using VRBO, then I take it, right? Or HomeAway to market your property or?
Yeah.
Eh,
So VRBO, but we also had so Disney in that Kissimmee area really has like a bunch of operators that have been doing this for years and years and years and years.
Yeah.
And so the community that we were in was 100% short-term rental. It was
Uh,
what we talk about is BTR, but they were
yeah.
building new assets, selling them, and positioning them as short-term rentals. So they wouldn't even allow us at the time. They wouldn't allow us to do long-term leases. It was zoned for STR
That
back
was
then.
BFR before BFR was even an acronym.
Yeah, yeah. So, um, but yeah, it was, and so we hired some property management company. It was like Villa, I think it was like Villa Direct or something like that. But they market to non-US. They market to people in Europe that are coming down for a Disney vacation. So they're two families traveling together, and so we built everything's about differentiating yourself, right? And so there's so many homes that were like 3 bedroom, for one family and a pool. We went big. We built a 6 bedroom villa with 2 master bedrooms, game room, the pool screened in, the whole works. Slept, you could get 14 to 16 people in there, depending on, we had 2 sofa beds too. And so we were trying to market to, families traveling together. And so they were market to people in Europe, in the UK, France, Spain, etc. And so all of those people would come down to, most of the people that rented our place was from UK. So this company Villa Direct was like the Airbnb at the time, one of the Airbnbs at the time, and they would market directly to people in Europe.
Gotcha. Was it a situation where you were forced to use Villa Direct for property management, or
No.
could you could choose your property manager?
Yep, I
How?
could do it myself, or I could hire somebody. And and back then, like, there wasn't all these automations, right?
Right. Right.
And so I remember during the time that we owned it, Airbnb launched, and so what Villa Direct allowed us to do was set up multiple websites. So we had a listing on Villa Direct, we had a listing on VRBO, we had our own website, for the property, and then I also launched it on Airbnb myself. And so the way I did that was, there's a way to, again, there wasn't automation, there weren't integrations, but like when I got an Airbnb order or whatever, I
Hmm.
would have to manually go in and mark that date for as an owner rental. Like,
Constantly manually syncing calendars across four
yeah,
platforms.
it
Oh,
was,
that sounds miserable.
yeah, it was not good. It was not good.
How much
Um,
was Villa Direct charging you?
a lot, from what I
What,
remember.
25%?
No, I think it was more. I I want to say it was at least 10%, if not more. But the other thing was, every work order was just a trip fee tied to it,
Oh
and
yeah,
a light bulb. I got to change a light bulb. It would cost me like $50 to change a light bulb. You
yeah.
know,
Nickel and dime you
um,
at every opportunity.
every opportunity. And then the other thing was, we lived far away, and I couldn't verify that the stuff that they were saying, like, oh, the pool pump's broken, that's going to be $3,000. Well, I don't know if that could have been an easier fix, rather than replacing out a whole pool pump or something like that. So
Yeah.
things like that really bugged me. We made a couple trips down. So the other thing about, again, investing is, every trip I made to Disney, it was a tax write-off, because I was going and visiting my property.
Oh yeah. There
Um,
you go. Yeah.
it was really cool. But every time we did go down, we would, like, we'd spruce the place up. I'd go to the local, like, patio shop or whatever, and I would get all new patio furniture and like new TVs and stuff like that. So we made it a family trip, but we also did some renovations of our own, that would have, the property management company would have charged me an arm and a leg to do, but I just
Sure.
did
Sure.
ended up doing it on our own.
It's funny how little has changed and how much has changed, man. Because in today's market, you have to stand out. You
Yeah.
need the villa with the pool that's heated and the TVs and the game room. Like that's as true today as it was
Hmm.
then. And at the same, like me and my family, right? We do the same thing, man. Like the properties that we personally own, we'll go stay in them,
Yeah.
and we'll turn it into a working vacation, which is tax writable, right?
Yep.
And at a minimum, you have a place that you can hold for free because tenants are paying the rent.
Yep.
And, even if you're only making a little bit, you have a place that you don't got to pay to stay somewhere when you go on vacation.
Yep.
You're getting incredible tax benefits, especially in STRs. And now that there's a lot of people that have figured out how to cost segregate them really well.
Yeah.
So like you get, there's a really cool vacation home that essentially costs you nothing to hold and provides you with tax benefits and really fun vacations because you get to spruce
Yeah.
up your place. Uh, Same exact thing happening today, man. Only we have like automation systems in place so that
Exactly. I
the
wish I had,
calendar.
and I'm a nerd for all of this automation. I have it all over my house, right? Automating everything and like can see everything. Everything's on an app. And I'm like, man, if all this was available, I could have literally kind of automated my whole thing on the STR that was in Florida, that was thousands of miles away. As long as I had, a solid cleaning crew and a solid
Mm-hmm.
maintenance guy,
Yep.
like I could have, the keypad on the door, like the codes, all that automation. I love it. Like you can do all of that kind of remotely. And so, really cuts into expenses, like reducing expenses down.
Oh yeah, it's incredible. I mean, we got in the short time we've been doing STRs since the end of 2020. We've up to about 20 doors in 8 cities in 3 states, and
That's awesome.
all we need is, like you said, number one, cleaners. And I don't care what they cost. I care that they're reliable.
Yep.
Like, frankly,
Exactly right.
and then number two, you need a solid handyman, or really a list of like 3 handymen, because sometimes their schedules, they get busy
Yeah.
and slow, right? So like one set of good cleaners, 3 quality handyman that you can call on, and then everything else, like, you
Yep.
can make automatic, literally, like new door code for every guest. It goes live the time that they're check-in and gets deleted an hour after checkout. And
Yeah.
all automated messaging, integrated calendars
Messaging.
across
Like,
25 different booking platforms, and now we have tools where you can see what page you're on Airbnb, so you can search engine optimize your listing. You can see you got dynamic pricing tools that are similar to what hotels do, where they
yeah.
all data share on what their nightly rates are. So they are like what airline seats do, like same thing in short-term rentals, man.
Yeah.
Like, what's the highest dollar amount we can get for this night?
And people don't appreciate that because I was managing, and this is, this is 2004, 2005. I was managing communications on my cell phone or email, and I was having to send, instructions and all that stuff all manually every time. Like now it's like, it's done. That
Yep.
automation is done as soon as somebody books it first. And pricing. I had to figure out pricing for my property. Can you imagine how much time that took every single
Yes.
time? Try to
Oh
figure
yeah, I
out.
could imagine it. Yeah.
Oh.
It's
So yeah,
invisible.
all this stuff has made things so much easier. And yeah, I really nerd out on it, right? Because like the data is there, like AirDNA and all these things, like
Hmm.
you can figure out exactly what. Oh, and I was talking to a buddy of mine also in the STR space, and they have historic data on like what drives their income and revenue up for each property.
Hmm.
And some of these things are completely arbitrary, like if you think about it from a gut check stuff, but he has data to back it up. Like, like for example, he said, we think that a sofa bed, if you have a sofa bed, you can sleep 2 more people. That actually drives revenue up. Well, all of his properties that have a sectional, right, for more people to sit
Hmm.
around in the living room area together, every place that has a sectional is actually driving more revenue. It's like counterintuitive, but the data shows that, for example. Second thing he said was, he's like, we put like a putting green and darts and like a ping pong table, a fire pit, whatever, all these things in the backyard. We put them in every single time, but he's like, nobody uses them. not a stig like nobody actually uses those things, but like um they drive your success rate in bookings. So people look for those. They look at, like, think about it.
Yeah.
You
Yeah.
have two, three, four couples that are going to stay somewhere together, right? And so it's so hard for somebody to make a decision to say, oh yeah, let's stay here, let's stay here. But if you have all these things, everybody's like, oh yeah, let's just stay at that place that
Yeah.
has, you
Obvious
know,
choice.
yeah. So like
Everything we could ever want and more.
everything is like, it's almost like clickbait. Like all those things, like nothing gets used, but like people book it because they're thinking in their head like, oh, that'll be a cool space to like hang out in.
Yeah,
But
for
nobody
sure.
because if they're vacationing somewhere, they're going to be outside of the house more than they are inside of the house. But like they still want to know, they want this like safety of like, oh, there's plenty of things to do at the house. And so
Yeah.
it was pretty funny because he's like, we spend the money on it because it's a clear ROI, because people end up booking our house over anybody else's in the neighborhood because we just have these fun things in the backyard, you
Yeah,
know?
it's absolutely true. No, yeah, anyone who's taken this industry been doing this in this space and taking it seriously for like a year, you can see that. It's an
Yeah.
obvious truth. And that's really the guard against competition too, because most people don't even know how to analyze data, like honestly,
Yeah.
and so they come in with a starter home and they get starter guests and to pay very little and break lots of things. And it becomes very easy to lose money in this space. It's one thing that I did that I kind of like to do, because I have this massive data set through AirDNA available to me that my management company, we pay for the nationwide service that integrates with Tableau. Well, anyways, so I started the data was quality enough that I could start doing regression analysis for individual amenities across the nation and by locale, right? And
Mm-hmm.
I know you know what a linear regression is, and I found the number one thing consistently, because I would be like, what does a pool generate in this locale versus that one? Like in Phoenix, a pool apparently gives you like $12,000 in additional revenue with a standard deviation of 18,000, which is not like obviously terribly predictive. It kind of speaks to like how much else in the property matters, right? When you have a
Yeah.
standard deviation like that, but it's also clearly a positive correlation. And then like in Denver, it adds $20,000 with only a $3,000 standard deviation, which is
Mm-hmm.
kind of interesting. But there's also very few homes with a pool, so
Right.
like it's an opportunity to stand out where like half the properties available for rent on Airbnb in Phoenix have a pool, right? So it actually,
Yeah.
you're kind of blending with the crowd, so I like do those types of regressions nationwide. And the number one thing I find in every locale, the number one indicator of how much money you're going to make is bathroom count.
Yes.
The
That's
absolute
interesting. That's so
It
interesting.
is. It is, but also at the same time, like that's like super convenient. Would you rather stay at a house with 4 bedrooms and 2 baths or 4 bedrooms and 3 baths?
Yeah.
Easy decision every
Easy.
time,
Easy.
right?
And that's so interesting because like we travel a lot as a family, and we travel together with family, and that's the limiting factor is the bathrooms. Like one of the reasons that we don't go four up in a single hotel room is because a single hotel room will only give you one bathroom, right? It's the same
Hmm.
concept. It's like, no, we always either double up or same thing with, yeah, you're absolutely right. We look for bathroom count every time we book an Airbnb. Yeah, because inevitably, like just getting ready, and that's a limiting factor. You're just sitting there
Hmm.
waiting. Yeah,
Yeah.
absolutely.
Yep. So I mean, and it really makes sense when you think about it too. It's like, aha, So now I only look for like if it's there's got to be essentially no less than one less bathroom per bedroom, and
Yeah,
ideally the same number.
yeah,
Those are the best. Like if I'm getting a 3 bedroom home, it better have 3 bathrooms,
yeah.
because now you're
That's
standing
that
out,
that
right?
makes sense. That makes sense.
So yeah, man. You threw out a couple terms and dude, you just dropped like so many knowledge bombs and golden nuggets. Like I really appreciate it, man. Like going through your story in such detail, and so I really appreciate that. There
Yeah.
were a few terms that I just want to make sure some people might like not have understood. So co-GP.
Yeah.
What is a co-GP?
Okay. So that's and I didn't even know the term at the time, right? So what ends up happening is when you're taking down a larger property, when you're taking down a syndication. So syndication is nothing more than a group of people coming together and investing their money together and purchasing, a property or purchasing real estate. Now, somebody has to put that deal together. So somebody has to go find that deal, acquire it, do the analysis, and say, this is the thing that we're buying. And that's usually the sponsor or the general partner, the GP. And so the GP can be a single person, it can be a couple people, it can be a company. But more often than not, there's multiple GPs on a deal, multiple sponsors on a deal. Because think about it, right? If we're only purchasing um, whatever a $4 million property, we only need to raise $1 million, $2 million. So it's relatively easy to put that together. But if you're thinking about purchasing $30 million property, you need a group of people that have enough liquidity and net worth and all that stuff to like qualify for the loan. Because again, the GP or the sponsor are also the ones that are signing on the loan. They're taking all the risk when they're purchasing this property. So there's two parts of a syndication. There's the GP and the LP. The LP is the limited partnership. So all of the equity, all of the money that we're raising is coming from the LP, and all of the work and the risk that everyone's doing is only in the GP. So the GP, the general partner, is the sponsor. Now, we got an opportunity to be a co-GP, which means we're not the lead. We're not the ones that are taking on all of the risk. We're not the ones that have acquired the property or put the down payment on it or the earnest money down on it. But they given us an opportunity because we're, at that time, the $30 million, they were raising 10 million. So it's really difficult for one person or two people to raise $10 million. And so what they do is they share the GP, they share the sponsorship with other people that are in the space. So they gave us an opportunity to say, hey, can you raise X amount, and can you sign on the loan as a percentage owner? So take on some of the risk as well and fulfill some of this some of these roles on the GP, which is like investor relations and communications and asset management. So all the work that's being done is being done by the GP team. So you can imagine if it's a larger property, you need more than one person. And so that's where we come in as a co-GP. So somebody gave us an opportunity to be co-GP where we couldn't take down that $30 million property ourselves. And so we partnered with somebody, and through that partnership, we were able to do that. Now it's come full circle. So now that also gave me the experience and the resume to say like, oh, I did that syndication. So now 15 deals later, now I have the opportunity to go and purchase a 10 or 20 or $30 million property. And I can give someone else a chance to be somebody who wants to be in this space and more than a limited partner, more than a passive investor. If you want to be an active investor and you want to be part of the GP, then I'm now able to give that opportunity to somebody else and say, hey, if you can raise $1 million through your network, you could come and be a co-GP with me on this new deal that I'm purchasing. And so that's all that means, is that you're getting a percentage ownership of the project, but you may not necessarily need to bring equity to the table. So it's sweat equity is the GP, and then the capital equity is the LP, if that makes sense.
No, that makes perfect sense. That was a really good breakdown. So I appreciate that. Really great talking with you, Param. I know that our time is pretty much expired. I'm sure you got other things on your calendar, man. So thanks for, man, I really appreciate you coming on. That was great. What's real quick before we end this, if someone wants to get involved with you through seeking, as to invest with you or to seek some type of other collaboration or partnership, Absolutely. What's the best way for them to do that?
Yeah, so partnerships are huge for us. That's the reason I just explained. This is the reason that we've been so successful is through all these different partnerships. So you know, I find in this industry that if you find somebody that's doing something similar to what you're doing, or somebody's doing something that you would like to be doing, partnerships is the way to go. Don't compete with people, partner, right?
Yeah.
And so
Hmm.
we found huge success in doing that. So yeah, so for us, we love to educate. That's why I go on these podcasts and we do our own podcasts. I love to educate people on how to be successful in the industry. And the greatest thing is there are so many different ways to be successful, right? There's so many
Yeah.
ways to make money in this industry. And so if you find people that are smart, I found people that were smarter than me, way smarter than me, and kind of rode their coattails, right? And trying to figure out. So now I'm trying to give back and share as much as we can. So best way to get in touch with me is our website. We're rebranding as we speak right now, but Spur Equity. So I live in San Antonio, and so my brother and I we did an homage to the San Antonio Spurs, but
Yeah.
also Spur Equity also means to grow equity, right? To spur some
There you
equity, and
go.
so SpurEquity.com is our company. You can find us on our website, SpurEquity.com, or you can email me, Param, Param, at SpurEquity.com. We're always looking for, partnerships, whether it be, equity partnerships or operational partnerships. We welcome that, welcome conversations on how we grow together.
Awesome. Cool. Well, thanks so much for joining me on my show. Part of much appreciated. And
Thank you.
anyone that resonated with Part in any way at all, please reach out. Such a great guy. I've been getting to know him, and always looking for partnerships because real estate is best played as a team sport. So,
Absolutely,
um,
100%.
well, thanks for coming on, Parham, and look forward to having you back on again sometime.
Great. Thanks.